So, you're dreaming of a second home in the UK. That's fantastic. But, and it is a big but, it can also be a bit of a tax nightmare if you're not careful. That's why we're here. The experts at Pro Tax Accountant have put this guide together to make sure your dream doesn't turn into a financial headache. We're going to break down everything you need to know. I mean, who doesn't have that dream, right? That beautiful holiday cottage by the sea, a slick city flat for weekend getaways, or maybe just a quiet country retreat to escape it all. It's such an exciting thought, but to turn that dream into a real plan, we've got to get a handle on the numbers first. And wow, those numbers can really be a shock to the system. Just look at this figure, £20,000. And no, that's not the deposit. That's just the potential tax bill on a £300,000 second property. It's the perfect example of why you absolutely need expert guidance before you even think about putting in an offer. Okay, so let's map this all out. We're going to walk through it step by step. First, we'll tackle that huge upfront stamp duty cost. Then, we'll get into the annual taxes you'll be facing year after year. After that, we'll look ahead to what happens when you eventually sell or pass it on. And most importantly, we'll dig into some really smart strategies to save you money before we wrap it all up. Right then, let's dive into the first big one, the biggest hurdle for most people, that upfront cost. When you're buying a second home in the UK, you're going to come up against something called stamp duty land tax, or as you'll see it everywhere, SDLT. Okay, this table really lays it all out in black and white. It shows the massive impact of that second home surcharge. See, on top of the standard rates, you're hit with an extra 5%. Let's look at the example, because this is where it gets real. For a £300,000 property, your tax bill just skyrockets from what would be £5,000 to a staggering £20,000. That's a £15,000 penalty just because it's your second home. Ouch. And believe me, this isn't just theory. This happens to real people. Take Aisha, a dentist from Birmingham. She found her absolute dream holiday home for £400,000. But then, bang! She was hit with a surprise tax bill of £27,500, all thanks to that 5% surcharge. It just goes to show how easily this can catch you completely off guard. But hold on, there is some potential good news here, and this is a huge pro tip. You might actually be able to get that surcharge back. Here's how. If you sell your original main home within 36 months, that's 3 years, of buying the new one, you can claim a full refund of that 5% premium from HMRC. This makes the timing of your property deals absolutely critical. So you've bought the house, you've got the keys. Fantastic. But the costs don't stop there. Now we need to look at the annual taxes you'll have to budget for, every single year. Now listen up, because this is a big one. A huge change is coming in from April 2025. Councils in England will get the power to charge up to a 100% premium on council tax for second homes. Let me just say that again. They can literally double your annual bill. This is a real game changer for second homeowners. And what if you decide to rent out your property to make a bit of income? Well, you guessed it, that income is taxable. How much tax you pay all depends on your total income for the year. As you can see, if that rental income pushes you into a higher tax bracket, you could suddenly find yourself paying 40% or even 45% tax on every single pound you earn from that rent. And here's a little did you know that honestly trips up so many landlords. The rules on mortgage interest have changed a lot. You can't just deduct the full interest cost from your rental income anymore. Nope. Instead, you only get a flat 20% tax credit. Now, if you're a higher rate taxpayer, this is a massive deal because it means you're paying way more tax and your profits get really squeezed. Okay, so we've covered buying it and we've covered owning it. But what about the long game? What happens when it's time to sell up or maybe pass the property on? Planning your long-term exit strategy is just as important as planning the purchase itself. So if you sell your second home and make a profit, you'll have to pay capital gains tax, or CGT. The calculation is basically a 3-step process. First, you figure out your gain. That's the sale price minus what you paid for it and any improvement costs. Step 2, you subtract your tax-free allowance. And finally, Step 3, whatever is left over gets taxed at either 18% or 24% depending on your income. This chart here shows a really important difference when it comes to inheritance tax. Your main home, your primary residence, it gets a special extra tax-free allowance. But your second home, it gets no such protection. It doesn't qualify for that extra relief. And what that means is more of its value is exposed to inheritance tax, which, by the way, is charged at a pretty steep 40%. Okay, now for the part you've probably been waiting for. It's not all doom and gloom about paying tax. It's also about being smart with your planning. So let's look at some of the key strategies you can use to be more tax efficient. One of the absolute biggest decisions you'll face is whether to own the property in your own name or to set up a limited company to own it. This slide lays out the pros and cons really clearly. Personally, your profits are taxed at your income rate. Through a company, they're taxed at the lower corporation tax rates. And remember that mortgage interest issue? A limited company can deduct the full amount as a business expense. The trade-off is higher admin costs and more complexity. For years, a super popular strategy was to qualify your property as a furnished holiday let, or FHL. If you met certain letting criteria, available for 210 days and actually let for 105, you unlocked some fantastic tax reliefs that regular landlords could only dream of. But, and here's the bombshell, from April 2025, the government is abolishing the entire FHL tax system. All of these valuable benefits you see on the slide, better mortgage relief, lower capital gains tax, they're all being scrapped. This is honestly one of the biggest shakeups in property tax for years. So that leads us to another pro tip, and this one is really urgent. If you currently own a holiday let, or you're even thinking about buying one, you need to review your strategy now. This change is one of the most significant we've seen in decades, and acting before that April 2025 deadline is absolutely critical. Now, there is one potential silver lining here for some holiday let owners. If your property is run like a proper, genuine business, you might be able to switch from paying council tax to paying business rates instead. And why does that matter? Well, the key thing is that small businesses can often get 100% relief, meaning you could end up paying nothing, which sounds a lot better than a council tax bill that's about to double, right? Whew, we have covered a lot of ground, haven't we? From the moment you buy to the moment you sell. But the single most important thing to take away from all this is that everyone's situation is unique. So, what are your next steps from here? Before we wrap up, let's just quickly recap the absolute key takeaways. Number 1, that 5% SDLT surcharge is your first massive hurdle. 2, your council tax could literally double next year. 3, capital gains tax is waiting for you when you sell. 4, the FHL regime is ending. And 5, how you choose to own the property is one of the most important decisions you'll make. Is it a lot to take in? Absolutely. The rules are complex and they're always changing, but you don't have to navigate this alone. A personalized plan, tailored to your specific circumstances and goals, is the key to moving forward with confidence. To take the next step towards your second home dream with confidence, get in touch with the experts at Pro Tax Accountant. You can call or WhatsApp them on 07985 689912 or send an email to info@protaxaccountant.co.uk to get your own personalized plan. And for more guides like this one, make sure you subscribe to the channel. Thanks for joining us.